Good morning, everyone. It's Ben Buckner and Dan Bossy with the Ag Resource Company in Chicago. It's Wednesday, July 2nd. We've got markets in the ag space this morning that are mixed. And I think kind of separating themselves fundamentally. I think a lot of these price movement this week has been really rooted in supply and demand. So we're entertaining the potential for pretty sizable increase in soybean oil disappearance. While at the same time, grains, there are just fewer unanswered questions. Wheat harvest is very active in the U.S., starting in Western Europe. And also the sort of graphic that's most followed in the analyst community, NOAA's precip temperature probability forecast. The update at 3 p.m. today, the 8 to 14-day temperature forecast, will cover July 10th to the 16th. Yesterday's forecast was pretty mild, so I think that is what's driving corn. But there's also lots of things going on in the background, Dan. If you just want to go ahead and break down what you're seeing this morning, I'll pass it off to you.
Yeah, Ben, well, thank you. Good morning, everyone. And there is a lot going on. We've got a lot of cross currents in the markets, if you can imagine. As we got the 45Z passed within the Senate bill yesterday, now heading to House for final approval, the soybean oil market has rallied. Of course, it's the first subsidy that the market potentially has seen, looking backwards to January 1st when we got rid of the $1 a gallon blender's credit. All of this opens the upside risk in soybean oil. You've heard us talk on this little video for quite a while now about not wanting to be overly short of soybean oil. You see that nice saucer bottom that's been forming in soybean oil. I would think that relative to the RVO and this now 45Z, soybean oil could maybe make it up over 60 cents, 60 to 63 cents. So we've raised our upside targets from 57 to 58 to 61 to 63, which we think is logical here today. Also within the same thing, I want you to look at the soybean meal chart. Hard to understand that these are cousins or from the same family, soybeans. But when you look at soybean meal, it's been one straight downside decline. We're now testing 10-year lows at 2016. We think there's a little bit of support between 250 and 255 at that 2016 low. But ultimately, the need to get rid of soy meal will probably break that 2016 low and then push more meal, if you will, into feed rations. So I think that's all more important going forward. One of the other aspects of the market is based on the RVO and now the 45Z, we've got to keep processing soybeans. And so crush margins are going to stay lofty, whether that's $1.60 as we've shown where we're at today, or maybe looking at $1.80. I think those are kind of levels that I would think about where crush margins will be over the next 6 months. Let's use a range of 140 to 190 in terms of valid margins. So we're going to be running crush facilities at record levels. And we need to understand where full capacity is, because at 90% of that is probably where we're going to see monthly crush going forward. And so there is this demand driver for soybeans on a crush related basis. We just don't have it on exports unless we get a deal with China. Talking a little bit about China here, there's a lot of talk going around this morning that the U.S. is posturing and looking at positioning in China in terms of not maybe doing a deal with them, but at least getting deals with others so that it pressures China to do something. If you look at it, we're getting close to a deal on India. We're hearing that maybe something could be announced. Whether or not we get over the GMO hurdle on India is unknown. But it does look like China, in terms of looking at their trade surplus, may be last in line. And we're going to see how the U.S. looks at the EU, looks at maybe Southeast Asia, whether it's Vietnam, Cambodia, Thailand, India, trade deals. And then it kind of segregates out China in terms of what it means for them. It takes away that export potential. If you notice the chart on the right, we have record large exports from China. I think the U.S. wants to step down on that a little bit with these trade agreements. And so that's what the process is. So what concerns me in all of this is we may not get a trade deal with China before the end of the year. This means that we go through a soybean sales season and export season without them being big participants. We'll see how this plays out. But I think this graphic and this story from Bloomberg here this morning kind of fits in that profile of what we've been thinking and talking about at Ag Resource. As you look at the soybean market, it is traded in a range. We've been in a range for almost a year now. Looking backwards since late July, we started this range in soybeans. It really is about $9.50, $9.25 on the downside. We've had rallies all the way up to $10.80. That's acted as a ceiling 4 times, and we're now coming off of that. Now, if we did get above that resistance level due to soybean oil, it's possible you could maybe run soybeans up to, like, let's say 11.25 or even 11.50 to fill that weekly gap. However, with weather being very favorable across the central U.S., my ideas and bets would be that we're now going to slide again, maybe back to that 9.25, 9.50 level relative to November if we don't have a weather problem. But let's watch soybeans very carefully within this range. Longer term, this is probably a bottoming process. But again, I don't see any evidence today fundamentally that we're ready to pop out in the upside, though, again, soybean oil will be relatively strong. When you think about U.S. weather, what I've done here is taken the temperature anomaly, and I'm looking over the next 10 days, or I should say the last 10 days of the forecast. This would be from the 7th to the 17th of July. And what you should see there is that blue area of below normal temperatures. That would be ideal in terms of what could occur for U.S. pollinating corn and for U.S. filling corn and blooming soybeans. So a wet pattern with cool temperatures would be just what the doctor orders, at least in the middle of July, hopefully heading into the end of July. So this is giving some backstop, if you will, to this record U.S. corn idea and talk that's now prevailing in the market. When you look at rainfall anomalies, and this is for the entire period, the 15-day period, you can see in blue here where the positivity will be relative to normal. So we're going to have above normal rain from Texas stretching up through Nebraska and then cascading eastward into Illinois and Indiana, and enough rain across eastern South Dakota and Minnesota to mention that. So when you think about the weather pattern, at least for the next 10 days to 2 weeks, it really is pretty favorable for the pollinating corn crop. No real extreme heat. The warmest day will be July 4th, followed by an abundance of rain that starts somewhere in the vicinity of late Friday and then continues forward on almost a daily basis. This is a graphic that Ben put together, and I want to give him the credit for it because I thought it was really good. As you look at U.S. Good to excellent ratings, what we've done here is a scatter diagram on the last week of June and its crop rating relative to yield. Now, again, the R factor on this is not the best, maybe in the low 40s, but nonetheless, it does give us some idea of direction. And as you look at this, that red arrow points out to 73% good to excellent, which is where we were on Sunday. So with that kind of good to excellent rating, it would tell us from the scatter and the trend line that's available that we would be looking at about a 4% above trend line yield. That would put it at 186 or 188 bushels per acre. There has been talk in the market of 190. We think that's a little bit of a stretch here today, but anybody that wants to talk from 183 to 188, no stones are being thrown by me. I think those yields are all possible depending upon how we finish out the growing season and what condition ratings do in the weeks ahead. Lastly, we'll kind of finish up here. Just everybody should be aware, U.S. President Trump will be in Iowa on Thursday. He's heading there for, of course, the celebration of the 250-year anniversary of the United States. I don't think Trump is going to Iowa unless he's going to say something positive for the rural and ag communities. Whether or not that's something to do with trade, we'll see. Maybe China announcement, but maybe more importantly, he can talk about supporting the U.S. farmer through income means, like maybe giving him tariffs back like we did back in 2019 in terms of Trump bucks. I don't know what's going to happen specifically. The market will watch this very carefully. There's this joke going around in agriculture right now that the best way to double your money in agriculture is to get 2 mailboxes. So I only say that because that's kind of the landscape as we see it heading into the fall. Note that if he did make an announcement on some type of support relative to the farm community, it would probably happen after September 30th, the start of the new fiscal year. We only have $3 billion in the CCC fund today. Congress would have to replenish it, and thereafter, maybe that kind of payment to the U.S. farmers could come back. So with that, Ben, back to you, and just wanted to go through where we are sitting today.
Yeah, so I think a really, really good rundown. And kind of in summary, think about the markets from a very high level. I think we're kind of at AgResource separating the two. So you've got vegetable oils, especially being used for biofuels, one. Maybe that also relates to oil seeds. But then think about the feed markets as well. There's a lot of hard red wheat. It's going to be probably 16 billion bushels of corn, a lot of soybean meal, and very low price DDGs. So thinking about all of those products competing for consumption and to clear excess inventories. And that's kind of the simple outlook that we've got. There's going to be a lot of stuff, at least during the autumn months. How does the cash market sort out having in total, 17.5 billion bushels of corn or something like that on October 15th. Just a lot of corn. So I think the cash market's got a bit of a chore to get rid of that. When the biofuel policy does change the dynamics, or at least the veg oil market. So that's kind of from a very high level what we're thinking about. And then the weather trend, I think the last couple of days, the trend has been cooler for the first half of July, and that just looks really good. So again, the nuances of corn yield are going to be, superseding just July temperatures and precip, but it does look pretty good to us, and that does give you the chance to see a yield we haven't seen in the last couple of years. So I think it's pretty simple to us. Fundamentals kind of rooted here. We're watching trade deals, biofuel policy, and of course central U.S. weather. So any final words before we take off, Dan?
No, I thought that was a good summary, Ben. Just remember, everyone, we're closed for the 4th of July, 4th holiday on Friday. So there's only 2 more trading sessions today and tomorrow. Thereafter, we're on break. So good luck with the day, and we'll see what we have ahead of us. But I agree with Ben, sliding grains and maybe a little support in soybean oil just based on biofuel domestic policy. Thanks again. Have a good day, everybody.
All the best. Bye-bye.